Yes?
This meeting is being recorded.
Okay, welcome and thank you for joining us today for the HHC Capital Corporation Semi-Annual Board Meeting. Today's meeting is officially called to order. For the record, please note that Karen St. Hilaire is representing Molly Wasso Park, Matthew Siegler is representing Dr. Mitchell Katz, and Dr. William Fisher is representing Dr. Jean Wright, all in a voting capacity. First on our agenda is the adoption of the minutes for the HHC Capital Corporation semi-annual meeting held on January 25th, 2024. Are there any questions, comments, or suggested changes? May I have a motion to adopt these minutes?
So moved.
Second. Okay, so I'll poll each member who's here. Dr. Pagan?
Yes.
Matt Siegler?
Yes.
Karen St. Hilaire?
Yes.
Dr. Calamia?
Yes.
Dr. Fisher?
Yes.
Sally Hernandez Pinheiro?
Yes.
Anita Kawatra?
Yes.
Jackie Rowe Adams?
Yes.
And I vote yes, so the minutes are adopted. So I will turn the agenda over to Linda DeHart, our Vice President for HHC's Finance and Corporate Reimbursement Division, to provide us an update.
Good afternoon. I want to first just remind everyone about the purpose of the Capital Corporation. This is an entity that was created as part of the security structure for H&H bonds. It receives our patient revenue as a pledge against our bonds. The Capital Corporation really does not have other business, and we generally use this semi-annual meeting as an opportunity to present an update on our H&H debt finance program. We meet generally in January to present the 6-month figures through July through December, and in July for the fiscal year-end figures. We needed to reschedule this meeting from July, but we are still presenting our June 30 year-end numbers, and we'll be back again in January with the next 6 months. So we are joined today by Minji Indar and Anikwa Brown from our Office of Facilities and Development. We have Pauline Locke, who you're all familiar with, is a longtime member of our debt finance team. For many years was our debt finance team. I am happy to introduce Thomas Tran, who's a new member of our team. Tom joins us with a wealth of experience in public finance, both on the investment banking side and as an issuer, including with the city and with LIPA. And Tom is going to be doing our presentation today.
Great. Thank you, Linda. Hello, everyone. Great to be here. So as Linda just mentioned, we're here to do an update on H&H Capital Corp. Capital Corp was created since back in 1993 to basically accept all the revenue that is signed by H&H to secure our bonds. So on page 1, you see that currently outstanding bond for H&H is approximately $408 million. If you look at the pie charts there, it's split between the fixed rate and the variable rate. The fixed rate is currently at $295 million, and then the variable rate at $112 million. Under the variable rate program that we currently have, it is supported by an LLC. They're currently backed by TD Bank, Series B and C, and then the other one is by JP Morgan, Series D and E. And you see there the breakout between $100 million for TD and $11 million for JP Morgan. And obviously the respective maturity that is due in those series, as well as the LC. The TD one the LC at least mature in 2027. Obviously, we're going to try to renew that because the maturity for that particular bond is in 2031, whereas the other one for JP Morgan, the maturity and the LC maturity, they both match. So they are both due in 2026. And then the other one about variable rate, not only is backed by the bank, by the LC, but it also has a remarketing agent who actually, the role for that remarketing agent is to reset rate on the variable rate bonds. Those agents are Morgan Stanley and TD Securities. One update here is that prior to February, the two remarketing agents were Morgan Stanley and Citigroup. Citigroup went out of business, so we basically had to replace them with TD Securities. So that's why there's a note there that we replace Citigroup with TD Bank as a remarketing agent. In terms of just give you a couple of snapshot in reset rate for the FY24 Q4, the reset was at 383 on 6/26, the end of that fiscal year. And then the average weekly rate since the beginning of 2024 is at 340. And then the latest one, at least prior to this print on 9/11, at 420. A note here is obviously 9/11 was prior to the FOMC rate action that occurred on September 18. So that rate since then, 2 weeks has gone by since that rate. So 420 has been gradually coming down. As of yesterday, which is the reset date on 9/25, was at 315. So obviously it's gradually coming down as the Fed taking rate actions. So we'll speak more about that in terms of more time horizon. And then comparing to the fixed rate, the saving here we are calculating here is about $74 million in saving when you compare them to a fixed rate. So that's on page 1. Moving on page 2, a little bit more of a profile of the 2 outstanding series. One thing, obviously, the current rating for the outstanding bond is a AA3, an A+, and AA- there with the respective rating agencies. One thing, obviously, we want to mention here, since 1993, HNA has been very active issuing bonds, total of 11 series, over 3.3 billion, but now we're down to only 2 series, and here we're down to $400 million. So we basically can say that we're deleveraging our portfolio over the period of time. So again, the 2 series that on the table that you see there on the right, the 2008 series, which I just mentioned, is the variable rate bond mentioned there, and then the 2028 bond is a fixed rate. And that series particularly has a refinancing component and a new money, which we'll speak about. But the number that we want to point out here, the refunding has saved us approximately $60 million on that deal. But on aggregate, in terms of over time, the refunding since 1993, the program has saved us about $145 million, including other series of bonds. And of course, we just want to mention also the general debt service that we lay out here in the bar graph. You notice that on the aggregate debt service, the chart right below the second bullet, you notice that it's basically pretty level, and then the debt service basically dropped in fiscal year 2031, and then it continued to drop, and then it leveled out in the outer years. And then the other 2 the bar graph, just to break out the debt service between the fixed rate and the variable rate. Moving on to slide 3, this is the chart that I was just mentioning that describes the historical rate for the 2008 BE bonds, basically variable rate. It's giving you since inceptions of these bonds, which is the x-axis. The y-axis on the left is basically representing the dark blue line that in the bottom is the actual rate that we actually pay on these bonds. And then the y-axis on the right, it basically represents the spread that is being priced against SIFMA. And SIFMA is basically stands for Security Industry Financial Market Association, is an index that the industry used to reset the tax-exempt bond on a weekly basis. So those are 2 lines that we're showing here, but one thing that we want to point out that you notice somewhere beginning of 2022, you notice the bottom line, the dark blue line, starting to trend up, as well as that showing that volatility since sort of beginning of 2022. Again, we just want to point out that because of the backdrop of the environment market condition during that time. If you remember 2022 and the beginning of that, the Ukraine war broke out in February of 2022. March of 2022, the Fed decided to raise interest rate and doesn't believe that inflation no longer transitory in 2021. So they basically started to raise rate in 2022, and they continue to basically raise rate throughout 22 and 23 for 11 times for a total of about 5.25% through the 2 year, 425 in 22 and another 100 in 23. So that's sort of explains sort of the trending line on there. In terms of volatility, again, these rates are set against SIFMA. One point of thing that we want to make is that SIFMA actually very volatile in 2023. SIFMA actually saw about 27 weeks where it fluctuated more than 50 basis points in that year. And then the other one to note is that as of year to date in 2024 is already fluctuating about 17 times, and we got another 13 more weeks to go. Obviously, we still have a lot to think about in terms of elections coming up, what the Fed is going to be doing for the rest of the way in terms of the pace of they doing a rate cut recently. Obviously, the cut that they recently did, about 50 basis point for this year, people still questioning whether how many they're going to do and how much they're going to do for the rest of this year. Based on the FOMC, the summary of economic projection, they're projecting is about 100 basis point cut for between now and the end of next year. 2 for this year, 4 for the next 2025, and then maybe another 2 in 2026. So it all depends the pace, meaning the amount of cut they do for each time they meet. So we'll see about that in terms of the volatility. So moving on to slide 4. Slide 4 just gave you a summary of the construction fund. Like I said, the 2020 was a refinancing, but it also has a new money component in here. So slide 4 is just showing you that $100 million construction fund for the new money is showing in this table. As you can see there on the first table, deposit was $100 million in 21, with the earning today it's about $3.4 million. And then you see the draw for four fiscal year since 2021, it's about $83 million. Actually, since then, since June 30 of 2024, we had drawn 2 on the construction fund for a total another $2.3 million. So that brings a total of that $83 million to about $86 million. Then the second table on the bottom there, just to show you sort of the budget, the encumbrance, and total drawdown, and the split between what is already accounted for and what's not accounted for, so that it's equal to that $19 million in the construction fund balance. Sure.
Should know the answer to this, but what triggers a drawdown and what triggers an encumbrance?
So the encumbrance represents a commitment. So for the project, if there are contracts that are registered and we create purchase orders, that can create an encumbrance. So it's basically a commitment of the funds. The drawdown happens after the funds are actually spent. The information is collected periodically and we reimburse ourselves from the fund.
Okay, thank you.
Okay, on page 5, it's actually just a little bit more of a granular information that's broken down by how we spend that, the drawdown, the $86 million. The split on the left-hand side, the bar graph showing you by facility, and then the pie chart on the right showing you by equipment type. In terms of the bar chart, the top 3 you see there, the percentages totaling above the bar graph is Belleville, Lincoln, and Amherst. And then the other next top 3, I guess, they sort of tie between Harlem, King, and Woodhull. And then for the pie chart in terms of equipment type, spending a chunk of that is in ventilation, roof, and imaging. Moving on to slide number 6, a little bit more descriptive in terms of the pattern of the spending. Again, the total spending through the 2024 there is about $83.9 million. A chunk of that is already spent on the equipment that's already completed back in December of 22 for a total of $22 million. And then the chunk of that left that really need to work on is the infrastructure, where the spending through the 2024 about $62 million, with the remaining of 19.5. Just a little bit on the pattern. spending about $5.6 million from the beginning of this year to June of 2024, comparing to the projected number of $11.6 million. In terms of fully spent, the remaining fund is expected to be another year since we were here last time. We're extending that timeline to June of 2026 from June of 2025. And then a chunk of that is obviously will be spent by June of 2025, and then the remaining $4.9 million will be spent for the remaining of the years. Okay, slide 7 is just an illustration in terms of picture-wise. You see there the actual spend in the bar graph, and then the projection with the line with the dotted. And you see there's a peak a little bit coming December 24, the end of this year, and then it start continue to trend down and wind down to a closeout of the construction fund. Okay, slide 8 is slightly a different program. It's still under the finance program. It's a little bit away from the bond program. It's actually an equipment loan financing. It's short-term financing that the board has authorized for $120 million cap. Under this program right now is pretty much only one loan outstanding, which is JP Morgan for the boiler in Amherst and Metropolitan. And currently outstanding is about $35 million. It was originally issued as a variable rate, and then it got converted. You see there, it got converted to a fixed rate at a 2.64%. And then on the last slide, just want to give you an update what's ahead of us. Again, like Linda said, there's no actions being asked today. It's just something that we're currently thinking about our next plan of finance. We have been working with OFD, EITS, and supply chain to come up with a funded list currently. And obviously, we're going to use that list to determine the size and the timing of our financing. And then, of course, we're also working with the supply chains to finalize a couple of RFP. That's going to be a crucial partnership in terms of bringing financing in the fall. That basically the MA, the Municipal Advisor RFP, the Underwriter RFP, and the Bond Counsel Legal RFP. And I guess with that, and turn it back to Linda.
So any questions? Thank you very much for the presentation, very thorough and informative. Any questions from members?
I just have a question. This is before you go through the process of selecting the advisor, underwriter, and bond counsel getting selected. I think Hawkins, is it Hawkins? It's been on Brothers Council for a very long time. But each time you've gone out, you've sent the RFPs and law firms, obviously, than just Hawkins.
Yes.
Do you think it's maybe too early to say, because you have to see what comes back, but is there like a feeling that you might consider a different bond counsel, or are you just waiting to see what comes back?
So that RFP is actually being conducted by Andy under the
And actually,
legal
it's coming
department.
before the board today. Today, the results are today. The result.
Okay.
So yeah, I mean, I'll just say broadly, we, in the RFP process, always consider all responses and, try to solicit a broad range of responses.
Right, okay.
Any other questions or comments? I just had a few. Well, first, Tom, welcome, and glad to have you on the team. I just want to emphasize or amplify some of the stuff you went through, but that the variable rate, while it is very volatile and has been increasing, has been a great piece of our portfolio, and having that balance over time. And you showed the history has been very, very low. I think the average over the life was less than 1%. And then also, as rates are going up on your borrowing cost, it's also going up on your investment side. So I think in the chart that showed where our proceeds were from the bond issue, the interest earnings on that side are also increasing as the borrowing's gone up. So I do want to emphasize that while there is a lot of volatility, and I'm sure it makes you a little nervous on where our rate's going and what's in your budget, it has been a good part of our portfolio. The other piece that just in terms of what you were mentioning that I noted is how much debt capacity we now have, that we've issued $3.3 billion. We're down to about $400 million. So the fact that we have been deleveraging, as you said, is providing the opportunity to go ahead with some of these capital plans that you guys are looking into. So I think the management process of that has been very, very good. So appreciate that, putting us in that position. The one question I did have for you was that some of the spending on the 100 million of the bond deal that we did in 2020, is it 2020, is still not being spent, right? You're extending the amount of time, and but we are also looking to borrow additional funds, and so just want to get some understanding of what the slowdown has been and how you're thinking about the borrowing for additional funds.
I think we can ask our colleagues to weigh in just in terms of the spending projections for those particular projects, but in terms of managing the fund balance with the new borrowing, we are starting to look at some of what's sort of been held to cover both. There was a small amount, I think, that we kind of set aside in case there were project overages, and planning now for this kind of extended trajectory. We're looking at whether we can start to initiate some small projects with some of these proceeds and sort of do a little bit of flipping. But I think we are, sort of, even though it's taken quite a bit, we're kind of down to tinkering around the edges. And so we are looking at it and trying to kind of minimize that trail as much as we can.
Okay. And what has been the primary delay, or I don't know, Menji, if you...
So I think during COVID, we had a lot of these projects put on pause.
Got it.
And restarting them, there were cost escalations, so dealing with that negotiation, that really added a significant amount of time to getting them restarted. But good news is they're all committed, so we should see the payments going out the door.
Right. And will you have flexibility to, let's say one project gets slowed down, to move money that you have to a different project that might be ready to go? Is that?
So I think all the projects that we have dollars left with are committed for the specific project. So I think we don't have any new projects sitting on the bench or projects that are unfunded that we can swap out for this bond issuance.
Okay. You mean the one that's been done?
The 2020, correct?
Right.
Sorry.
Yeah.
Yes.
Okay.
I think for moving forward prospectively, for the new issuance, we are.
I think, right, for those projects for those amounts where they have encumbered the funds, and what Minji is referring to, we're sort of holding those for those encumbrances where they have a commitment. There is, as you see on the chart, about $6 million that is unencumbered, and that's the piece that we'll be looking at to see whether we can accelerate some things to take that up. I think, as you know, we're also looking at the potential of arbitrage risk on this fund, and probably would set some of it aside for that.
That's good. Great. All right. Well, thank you. Oh, go ahead.
So I was just asking Nico at the $6 million that's unencumbered, and that's really just change orders for those projects, so they will be committed at some point. So we have them committed in our minds. We just haven't gotten the paperwork.
And she's like, "What? No, you don't spend that money. We got it." Great. All right. Well, thank you very much again. And I will see. I think nobody has any questions. So, is there any old or new business from members to come before this board? If there's no further business, I declare this meeting adjourned.
This meeting is no longer being recorded.